do not get. And we're going to spend a good amount of time with the sheet that I just, you guys just took, looking at the cash versus accrual accounting and what the effects are there. Because this is an area that is going to be probably a little bit challenging to you guys because you've been so ingrained with GAAP accounting and how accrual works. And of course, tax does it differently, and it's going to go against your better nature in some places. But we'll use the handout the best we can to kind of get you guys through where these differences lie. Okay guys, so just as a reminder, there's several different types of businesses for taxing purposes, okay? We have corporations, and corporations, guys, are separate legal entities. They have the same rights that you and I have. And as such, guys, they are required to pay, file and pay taxes. They use a Form 1120. We also have partnerships, S corporations, LLCs, and these are all generally taxed as pass-throughs. And we've talked a little bit about what pass-through means. These types of businesses, guys, they file tax returns, but they don't actually pay taxes, okay? Their returns are informational in nature. What they do is they send the return in. They also attach generally a K-1. And these K-1s divvy out all of the income of the business and all of the expenses of the business to the partners or to the members of the business. They take this income, they take these expenses, and they include it with their own personal income and personal expenses on their 1040. They merge both their business and their personal income and expenses together and report it all as one on their 1040. And then we have our sole proprietor, guys. Okay, we've talked about him a bit here and there, but we'll focus on him more now. Okay, our sole proprietor, assuming his business activities rise to the level of trade or business, okay, it's regular, it's continual, it's material in nature, his transactions, then he's going to fill out a Schedule C. Okay, he's going to report all of his business revenues, all of his business expenses on that Schedule C, except for certain expenses for himself, right? Because he's not an employee, so he can't deduct on there his FICA taxes, he can't deduct on there his health insurance costs, he can't deduct on there his pension costs for himself, okay? Those may be for AGI deductions, okay? But his other business expenses, he's going to subtract from his business revenue. He's going to come up with that profit number, and that's going to be his gross income on his tax return. Okay, so his Schedule C feeds into his 1040. Guys, businesses do not get personal and dependency exemptions, obviously, but I will point it out. They don't have dependents, they don't have personal needs, and they don't get standard deductions, okay? They do not get standard deductions. Because the income rules are generally going to be the same, okay? Businesses, for the most part, are going to derive their income from the sale of inventory, or they'll have service revenue from servicing clients. They might have income from working capital needs, okay? So they might have certain investments and they may report certain capital gains. They may keep, you know, invest their overnight money and have some returns on that. And they may occasionally sell assets, okay? So they may have to report what we'll talk about eventually, 1231 gains, 1231 losses. We will get into that in I think the last chapter. But, you know, guys, there's still exclusions, there's still deferrals. You know, the same things we learned as far as income goes for individuals will apply here, okay? So, you know, our muni bonds are still treated the same way if they're held by a business, okay? They're going to be tax exempt. The same thing with life insurance policies, okay? If a corporation holds what are called key man life insurance policies, which we'll talk about more in a minute, that income to them is not going to be taxable. So those same exclusions still apply, the same deferrals still apply. Now guys, we learned that deductions are a matter of legislative grace, okay? Meaning you cannot take a deduction as an individual unless you can point to a provision in the code that tells you you can take that deduction. And for the most part, most of our expenses as individuals are personal expenses, but Congress gives us certain deductions because they want us to do certain things, like get educations, buy homes, save money for retirement. So essentially these things are personal, but because Congress wants us to have certain of these things, they do grant very specific deductions as individuals. Now, businesses are treated much more generously, okay? They get a lot more, I'll say, grace than we, the individual, do. And the idea here is that they want to tax businesses, guys, on their net increases in wealth, okay? Their revenues minus their expenses. They want to tax them on that net increase in wealth. And the idea is that these businesses are incurring expenses in order to generate the revenue that Congress is ultimately going to tax. So they should be allowed a deduction for these expenses. And there's a code section, it's code section 162, that are granted specifically to businesses, okay, trade or business activity, that grants them these level of deductions. And this code section says that they can deduct all of their ordinary and necessary expenses paid or incurred related to the trade or business, okay? This is for businesses. There is a similar provision, guys, for investment activity. We talked a little bit about the difference between trade or business and investments. Trade or business, guys, is when you're involved in something, again, on a regular, continual, and material basis. But you might have certain activities that you enter into specifically for profit purposes, but you're not doing them on a regular or continual basis, okay? But even here, they do grant you the ability to deduct your expenses in generating this profit-driven transactions, and that's under code section 212, okay? And then, of course, guys, if you're really in an activity and you're making money from it, but you're really entering into it more for personal or pleasure-related reasons, of course, we talked about hobby expenses, okay? So that also is another option. But generally, your trade or business is going to be under 162. And again, your expenses have to be what are called ordinary and necessary, okay? And the book breaks this apart a bit, and I'll walk you through this a little bit. Guys, ordinary expenses are considered, you know, acceptable or appropriate expenses, things you'd expect to see from that business. So if you have a landscaping business, guys, you would expect them to be deducting the cost of gasoline for their mowers. You would expect them to be deducting, you know, repairs and maintenance, you know, things of that nature. You're not going to expect to see this landscaping business deducting, you know, paintbrushes and paint. So it's things that are, you know, common, things that are appropriate, accepted, reasonable for the business. What it does not mean, though, is it doesn't have to be something, you know, habitual, okay, something routine. Your book gives you the perfect example of a lawsuit, okay? Hopefully your company isn't engaged in a lawsuit on a regular basis because you probably wouldn't be in business too long. But it's part of business, okay? Any reasonable company is going to be expected to defend itself, and so it's an appropriate deduction if and when it occurs. A lot of companies, guys, may go through business process changes. They may hire consultants, and it's, you know, they may spend several $1 million, you know, paying consultants to come in and revamp the business, streamline things, okay? These aren't things that you do on a regular and routine basis, but nonetheless, it's appropriate for the business to do. So it would be considered ordinary in that case. Now, necessary, guys, is a little more open, okay? It's just really things that are helpful to the business. It's things that are conducive to you getting the job done. It doesn't mean that, look, you can't deduct this expense. You know, it's an absolutely critical expense, otherwise you can't take it. You know, the business won't survive. It's just anything that you deem to be helpful, anything for you to get the job done better, okay? There is a court case, a Supreme Court case called Welch v. Helbring from 1933, and most of the rules in this case kind of defined this area. Here we had an employee. He worked for a company, and the company went bankrupt, and they left a whole lot of debt in their wake. And this employee decided shortly thereafter that he wanted to go out on his own. He thought he could do this better. And what he did in setting up the business is he went around actually, and out of his own pocket, he paid the debts of his former employer because he wanted to right the wrongs done to these vendors and these other parties. And he thought it would help establish his reputation as an honest businessman, and I'm going to do right by you, and I'm going to do things differently. And he thought really this was the only way to get it done. And he deducted these costs as ordinary and necessary. And the courts agreed with him that, look, these costs, doing this was probably absolutely necessary. It was definitely helpful. It put you on the right path. You know, no argument there. But they said, look, these are the actions of an extraordinary man. Most people weren't going to come in and pay off someone else's debts. So yes, while it was necessary, they weren't ordinary, okay? This was actually very extraordinary with their terms. So hopefully that gives you a little bit of a flavor for the difference between ordinary and necessary. says your expenses have to be ordinary and necessary, okay, but there's this reasonableness requirement. There's always a reasonableness requirement when it comes to business expenses, okay? And if they're gonna challenge you on something, guys, this is probably gonna be the area where you're gonna get challenged as a business, okay? It's probably not gonna be ordinary or necessary. The IRS is not in the business of telling companies how to run their operations, okay? They're not usually gonna haggle with them over what is an appropriate expense item or not. But if they're gonna challenge you, they may be telling you you've spent an above average amount of money on what a routine expense should be. And they're guys, look, they're just gonna look, the fair market value. Are you paying fair market value? Are you paying what someone else would have paid for this? It's a little bit of common sense in this area. But I will tell you that it's facts and circumstances based. What may sound extraordinary to you and I may not be extraordinary. I will give you the case of, I have a girlfriend who worked for the corporate office of Chanel in New York, and I remember at one point they were redoing their offices, and actually they were redoing the boutique in New York, which any of you have ever been in there. I think they were spending something at the time, this is probably close to 20 years ago, like $500 on like a roll of wallpaper. I don't know, it could have honestly even been like a square foot. It was something completely like, what? Like outrageous. But when you stop and say to yourself, okay, that's Chanel, and they're selling a bag this big for $6,000, okay, based on the facts and circumstances, it probably wasn't really gonna be challenged, okay? It wasn't Target where we wouldn't expect them to spend $500 on, a square foot of wallpaper. But given that it's Chanel, it's going to be a whole different ballgame. So there's no hard and fast rule. I just don't want you guys to think that there's one rule for everybody, one size fits all, because it's not. It's a very facts and circumstances driven test. And a lot of the code is written that way, guys, okay? There's no sort of black and white. Okay, so 162 gives corporations, guys, I shouldn't just say, I'm saying corporations, guys, but I'm talking business in general, but I'm going to keep saying corporation. So 162 gives businesses this sort of broad power to deduct their business expenses, okay? But they do what they do best, guys, and then we pull back, okay? Because we know things will be subject to abuse. We know there's certain types of expenses that Congress is not going to grant. And now we're going to look at some of the areas where they're going to pull back on 162. So first they say, sure, deduct anything that's ordinary, necessary, reasonable. But we're not going to let you have some of these things, and that's what we're going to hit right now. Okay, guys, the first stuff that is not allowed, okay, the first few items, are things that undermine public policy, okay? Fines and penalties to government agencies. Fines and penalties payable to government agencies. So I'm a sales rep, and I spend, a good portion of my life driving around in my car going, let's say, from doctor's office to doctor's office. And it would be very reasonable in my line of business to expect that I'm going to get a speeding ticket or 2 or 3 here or there. And you could very much make the argument that, well, this was done in my pursuit of my trade or business, okay? But since that speeding ticket is getting paid to a local township or the state police, okay, it would be non-deductible. Yes, it's in your line of trade or business. You're trying to further your trade or business, but it's specifically not allowed, okay? Same thing, if a company forgets to file and pay their taxes. Right? We talked about the penalties for failure to file, failure to pay. Non-deductible, guys. Those fees are paid to a government agency, okay? But let's say I'm that sales rep and I ordered, I'm supposed to order a bunch of drug samples from my vendor, okay? And I forgot to do it on time. So the vendor turns around and hits me with a shipping penalty, a rush penalty. That's okay, that's deductible, okay? That's not getting paid to a government agency. So don't just think that all fines and penalties are non-deductible. They are, just the ones to the government agencies are not, okay? Okay, guys, bribes, kickbacks to anybody, okay? Not just government agencies. You cannot deduct a bribe. You cannot deduct a kickback to anybody, government agency or not. I don't know who would try to deduct this, but people do strange things, so. But here's a better one for you, okay? With that being said, you cannot deduct bribes, you cannot deduct kickbacks, guys. But businesses engaged in illegal activities can deduct their cost of goods sold, and they can deduct their expenses, just not fines or penalties to government agencies or bribes or kickbacks, okay? But they can deduct their cost of goods sold, and they can deduct their other expenses.
Businesses engaged in
illegal activities can deduct their cost of goods sold and their business expenses. Okay, just as long as it's not a final penalty to a government agency or a bribe or kickback. Okay, so if I have a weekend business, making knockoff Prada bags, I can deduct my cost of goods sold for making the bag. I can deduct my costs for paying my guys who stand on the street corners and sell them. I can do that, okay? Who's gonna file that? Look guys, most people aren't gonna willingly file illegal tax returns alerting the IRS that, by the way, look at my illegal business here. But the fact is they may go back if they get caught, okay? They get caught for something, and then, oh, by the way, you're not only in trouble with the authorities, now you're in trouble with the IRS. Their attorneys and their tax people are gonna come in pretty quickly and back file all these taxes. Because again, if they never filed a tax return for these activities, their statute limitation is wide open and running indefinitely. So they're gonna have tax people come in and recreate tax returns for all of these years to get them up to date, to start minimizing the amount of penalties out there, guys. So that's usually when someone is gonna take advantage of these rules. They're not usually gonna willingly do it up ahead of time, okay? Political contributions and lobbying, guys. The general rule here is that they're not deductible, okay? It would be very self-serving of the government to allow political contributions to be deductible. So they shy away from it. They're not allowed. There's a very, very, very small exception for lobbying expenses. Your book only covers one of them. There's actually a couple, but we'll stick to this one, okay? You can deduct certain lobbying expenses if you pay to have prepared materials for submission to a local government agency if it relates to proposed regulation that affects your business. Okay? So what does that mean? I don't know where. I'm an oyster farmer, okay, out on Long Island. This is my business. I'm an oyster farmer, and the local town council is considering having those huge wind turbines placed in the ocean, not far from where my oyster farm is. And I'm very afraid that it's going to damage and disrupt the environment. Well, I could pay to have materials, information prepared for submission to the local town council explaining how this is going to hurt the business, how this is going to affect the environment, etc. That would be an example of where a lobbying expense would be okay. It's a very narrow exception. The general overwhelming rule is that political contributions, lobbying expenses are not deductible. Your book touches on capital expenditures. We're going to talk much more about this in 2 weeks, okay? You guys know from your basic accounting classes, guys, if you have an asset with a useful life of more than 12 months, okay, you purchase an asset with a useful life of greater than 12 months, you have to put it on the balance sheet. You have to capitalize it, and then you can depreciate it. If it's intangible, you may be able to amortize it. And we will talk a lot about depreciation and amortization starting in 2 weeks. You are not allowed to deduct expenses that lead to the creation of tax-exempt income, okay? They can't tax the income, guys. They're not going to give you an expense deduction. Yes. You cannot deduct expenses that lead to the generation of tax-exempt income. And 2 areas in particular, guys. We've learned about 2 types of income that are excluded from revenue, okay, in our earlier classes. The first ones are our munis, okay? Our interest on our state or local bonds, we've learned, is tax exempt income. So let's just say I borrowed $50,000 as a business this year, and I ended up paying $5,000 on that interest, okay? And with that $50,000, I went out and bought myself a stock portfolio that includes $40,000 worth of corporate taxable bonds, right? And $10,000 worth of munis, okay? So 20% of my bonds purchased with these borrowed funds that I paid $5,000 of interest on would be not deductible. They're only going to let me deduct the portion of the expense that relates to taxable income, okay? They can tax the revenue, they're going to give you the expense deduction. If they can't tax the revenue, they're not going to give you a deduction. It's the yin and the yang. Sure. I borrowed $50,000 and I ended up paying $5,000 in interest on it. Okay. I used the $50,000 to go out and buy a portfolio of stock. Some of it is taxable stock, some of it is tax exempt stock. So I spend $40,000 in corporate bonds, which are taxable, and I spend $10,000 on municipal bonds, which generate, tax exempt income. So only the portion related to the taxable income would be deductible. The other portion, since this is going to be tax exempt income, they're not going to give me a corresponding deduction for that portion. So of my $5,000 interest, 20% related to tax exempt income. So they're not going to allow me that 20% portion of the interest. Okay, because I incurred that interest to generate income. And typically the rule would say under 162, you spend money in order to generate income, you get a deduction under 162. But if that income is tax exempt, it's excluded by other provisions of the code, we're not going to give you that deduction. So they're only going to let me here have $4,000 instead of all five. Okay. I also mentioned a little bit about life insurance policies. A lot of businesses, guys, have what are called key man policies. Okay, they're going to put insurance on the heads of the organizations. Okay, these people are valuable, and the idea is that if something happened to them, they would take this money and it would help them keep the business going without this person. So it might be on like their rainmakers, people who really generate revenue for the company. So that some of this life insurance money would help stop the gap of where your commissions are no longer coming in. It may help pay for, your recruiting CEOs, CFOs. There's some pretty hefty headhunting fees that go attached to that, hundreds of thousands of dollars. This life insurance policy may stop some of the bleeding from these expenses. So any policy, guys, where the company, the business, is named as the beneficiary of the policy, okay, that's going to be tax exempt income to the organization under our life insurance rules that we learned in Chapter 5. Okay. Now we have to pay for these policies, okay? But since the income that we might collect from these policies would be tax exempt, they're not going to allow us to deduct the cost of the premiums related to these policies. Good. Super quiet. Okay, guys, personal expenditures, the book kind of touches on. Look, personal expenditures, guys, Code Section 262 says that any family or living expenses are not deductible. We covered in Chapter 6 certain exceptions, again, that Congress gave to us because they want us to do certain things, again, like get education, save money for retirement, buy homes, okay? Those are exceptions to the general rule of the cost of living, the cost of providing for your family are personal in nature and non-deductible under Code Section 262, okay? But even as far as businesses go, there are certain exceptions, and we've touched on a couple of these before, but we'll cover them again, okay? Clothing, okay? Clothing. You may be able to deduct the cost of clothing as long as it is not readily adaptable to streetwear, okay? So you need a uniform, you're a fireman, you're a policeman, okay? No one expects you to walk around in your uniform all weekend, on nights, you know, on your days off. That would not be normal, okay? A man's business suit. Now some of you may say, look, I will never wear a business suit. I don't want to wear it. They make me wear it for work, but I didn't want this suit and I'm never going to touch it except for going to work. The fact is that a lot of people do wear them though. A lot of people wear them on weekends to go to temple, to go to church, to go to weddings, okay? So those are streetwear. So you're not going to be able to deduct the cost of your business suit whether or not you really wanted to buy it, okay? And your job forced you to buy the suit. There was a court case, going back to Chanel, I don't know if she worked for Chanel, but there was a court case with a woman who worked in a very, very high-end boutique, a Dior, a Chanel, one of those. And, you know, the company basically, and I know that they do this, kind of say, you want to work here, you got to wear our clothes. And they do give deep discounts on the clothing. But nonetheless, it's still expensive even with the discount. And the woman went to court and said, look, I would never buy this stuff. You know, this outfit I'm wearing is like $6 grand. And, you know, I'm not going to wear it at home when I'm, you know, feeding my kids spaghetti and, you know, they're going to get it on this outfit. And I would never wear these clothes. It's not, you know, they're making me buy this if I want to work here. It's a requirement of my job. And she actually lost the case. And they said, look, you know, the fact is we get you don't want it. We get that the only way, you know, you get to work there is if you buy and wear their clothes. But nonetheless, you know, the fact is there are women out there who do wear this every day. And it is street clothing and you don't look funny when you go out in it. So it is not going to be deductible to you. So again, guys, the idea here is that it has to be, you know, if it's adaptable to streetwear, then it's non-deductible. Okay, if it's a uniform, something of that nature, that's different. You can deduct it. Okay. Education expenses. Okay, guys. The general rule on education expenses, the general attitude has always been that education is personal in nature. Now we've seen quite a few exceptions to that, and I think we've even touched on this before. Okay. There are times though when you can consider your education in pursuit of your trade or business and therefore deductible as a business expense. Okay, and the general rules here say that the education has to be to maintain or improve your skills. Okay, maintain or improve your skills. Or the education is required to meet the express requirements of your job or to meet some sort of local or not so local law. Okay. You're only getting this education to keep up with the requirements of your employer or some sort of state law that requires you to have some sort of education. Now, if the education, guys, is qualifying you for a new field of work, it's not going to be deductible, okay? So, you know, you're going from accounting and you decide, you know, you want to go into law, that's not going to be deductible because you're getting qualified for a whole new field of work. Okay, there's also a rule that says if you are gaining the minimum education requirements to enter a field, that is not going to be deductible. So that's where you guys are at right now. You guys are, for the most part, gaining the minimum education required to enter you into the accounting field. Okay, so your educations generally are not going to be deductible for business purposes. Okay, you may qualify for other credits or deductions, but for business purposes, you're not going to be able to take these. The idea is that only if it's maintaining or improving your skills in a given line of business, you can deduct them.
How's grad school with that then if you already have a job?
Depends on what you're doing. It really depends. Like I could tell you if you're going for like accounting right now and you want to come back and go into like a master's of finance program, a master's of tax program, that would probably be deductible as part of a business. You could take it for business reasons. MBAs are sort of a shady area because are you specializing in something or is it qualifying you for something new? That's a little more of a shady area. If you are a lawyer, you went to law school and now you want to go back for an advanced degree, you want to go for your LLM, that will be deductible, that'll work, you're specializing. So it really, again, is it qualifying you to do something new that you couldn't do before, then it's probably not going to be allowed, which is always a question with the MBA. But if you're specializing, that'll work. That'll work, okay? And again, guys, this is as a business deduction. The idea here, again, is that you are deducting these expenses because they're furthering you in your trade or business, okay? Okay. The book has a whole area on mixed motive expenses. We've talked about some of these, but we'll run through them again. Okay, guys? Mixed motive expenses, guys, are items where, yes, there's business aspects involved to it, but the fact is there's probably also some personal aspect to it, okay? And there's two particular areas that the IRS really heavily scrutinizes here because these are subject to a lot of abuse. The first is meals and entertainment, and then the second is travel. Now, as far as meals and entertainment go, guys, look, they're only deductible up to 50%. 50%, that's it. That's all you can deduct. And it's two reasons. Again, because this is an area that does and is subject to a lot of abuse, so they only give you 50%. And the fact is, guys, that there is a lot of personal nature in these types of expenses. I mean, you have to eat anyway, okay? And technically, eating is a 262 living expense. As far as entertainment goes, I mean, the fact is yes, you know, you may be getting some business done, you may be entertaining a client, but you're probably, for the most part, doing something you wanted to do, okay? Let me take my client out for a day of golf. Let me take my client to the Yankees game. You know, let me take my client to see whatever recent Broadway show. Okay, there's a certain amount of personal involved in this, so these things are deductible only to 50%. Now for meals, okay, there's a couple of requirements. They have to be reasonable, but we've already said that, okay? They have to be reasonable. The rules say that the taxpayer or one of his employees have to be present at the meal. Okay, so the taxpayer, the business owner himself, or one of his employees have to be present. Okay, you can't just, you know, send the client out to lunch and say, hey, I'll pick up the tab. You can do that, okay, but it's not going to fall within these 50% deductibility rules. More than likely, guys, it would be perceived as a gift, okay, and it's subject to a $25 limitation. So you send your client out to lunch, you know, and it costs $500, and you're not present. Again, you're probably going to be able to deduct $25, not $250, okay? And the other requirement is, look, business must be discussed at this meal or immediately before or after it, okay? You have to discuss business. Now, for entertainment, rules aren't drastically different. Again, it has to be reasonable, okay? You have to entertain a business associate. That doesn't mean a client, guys. It could be your attorney. It could be a vendor that you're doing business with. It could be, you know, an employee, okay? And it says, you know, business has to be discussed either during the entertainment, which may be hard. So they bend here and say, okay, if you can't discuss it at the entertainment venue, then again, you could discuss it immediately before or immediately after. So you can go to dinner and discuss business at the dinner and then go to see your Yankee game, whatever. That will work, okay? But business needs to be discussed. Couple of things here. The point of this business meeting should be you have to have an expectation, you know, that business is going to get done. You can't just kind of say, hey, let's catch up and not really have any plans for doing business. Okay, the rules say, actually the regs say, the main purpose has to be the active conduct of trade or business. You need to be doing business. It doesn't mean you have to walk out with a new account signed, okay? But it means you have to have a reasonable expectation that business will follow from this meeting. Now, a couple of small things, especially as far as entertainment goes. Okay, guys, we said it's deductible up to 50%, but 50% of what, okay? You know, Taylor Swift, okay? Your client wants to see Taylor Swift, and you can't get the tickets, so you have to go to a scalper or you have to go to StubHub, and you end up paying, you know, $1,000 for 2 tickets because this is something your client is dying to do. Well, you can't deduct 50% of $1,000, okay? If the face market value of those tickets is $100 each, so $200 together, you have to deduct $100, 50% of the $200, not 50% of the fair market value or the what you paid, okay? It's 50% of the face value. They're not just going to give you a deduction for, you know, sure, I went to the street corner and I paid, you know, Joe $2,000 for a couple of tickets. They're not going to let that happen, okay? It's 50% of the face value. Okay, there's another rule, guys, that says if you pay dues to a sporting, athletic, or social club, okay, think country club, I guess, okay, no portion of those dues is going to be deductible. Even if you do all of your trade or business at this club, okay, you cannot deduct any portion of this dues. But if you do business there, you take a client to play golf there, you feed them a meal there, those costs are deductible to 50%, okay? So country club, you spend, you know, $20,000, $30,000 a year to belong to whatever country club. Those are your dues. And then you take clients there and it costs you another $500, $600, $700, whatever it is to play golf, have lunch, okay? You can deduct no portion of the 20, 30 grand in dues, but you can deduct 50% of the cost of playing the actual round of golf or sitting down and having a meal, okay? And again, guys, it's because this is an area for abuse, okay? Most people are joining these clubs. Yeah, they may be doing business there, but really there's a huge personal benefit to joining these clubs, so they're not going to give you the deduction for it. But they will grant you the deduction for anything that is directly business related. Okay, the second area, okay, that the IRS will heavily scrutinize, guys, is travel and transportation expenses. Again, I encourage you to break down these travel expenses into two components, guys. Transportation being the first, okay? Transportation, guys, is really any costs in getting you to and from a business location, okay? So you have to fly to, I don't know, St. Louis. You get in your car in the morning, you drive your car to the airport, park it at the airport, you fly to St. Louis, you take a cab or you rent a car when you got there, okay? All those costs in getting you to and from St. Louis are your transportation expenses, okay? That's one component. And then the other component are all the expenses once you hit the ground, okay? So your hotel, your meals once you're there, entertain your client while you're there. Maybe you have to rent a conference room in the hotel to meet with the client. Maybe you have some conference fees, whatever. Once you're on the ground, though, those are your travel expenses. Now looking at the transportation expenses, guys, okay? Your daily commute to and from work, we've talked about this before. It is a personal living expense under Code Section 262. Okay, your daily commute to and from work, guys, is non-deductible. But you're generally going from home to a client, home to another office you don't normally go to, or you're going from, let's say, your office to another location, another business location. Those are all generally going to be deductible. Okay.
If a company covers your gas expense, like to drive to work, is that income for you?
Compensation. You're accounting for it? Yeah, I mean, yeah, it would be compensation because you're going to and from work is compensation. Yeah. Okay, guys, if you use your personal automobile, we'll cover this, okay? You use your personal automobile, you have one of two options available to you, okay? Under the current rules right now, you can track your business mileage and deduct 57.5 cents per mile, okay? Alternatively, you can track the actual operations of your car. Again, watch your mileage, and then you can sit down and add up the actual operations of your car. So your lease payment, your oil changes, your insurance, your registration, gas, okay? And then you can deduct based on, you know, your personal mileage versus your business mileage. You can deduct the actual expenses, okay? Two options. So again, the 57.5 cents a mile, guys, includes all of the operations of the car, including your gas. It does not include tolls. It does not include parking. Those are above and beyond. Okay, those are separate extra deductions. So as a business owner, you have this choice though. You can just easily, without having to go through a whole lot of calculations and documentation, say I'm just going to deduct 57.5 cents. But if you're good at keeping records and it gives you a bigger deduction, you can track the actual operating expenses of your car and deduct that accordingly. Now I will tell you, guys, if most of you go to work for a company, they're not going to allow you to track your actual costs and deduct it. You're just going to say you get a standard mileage rate. You're not going to get an option as an employee. This is really more if you own the business, okay? You have these choices, but your employers, when you go to work, are generally just gonna give you the IRS allowance. They're not gonna give you this option. But for IRS purposes, it is out there. Okay. So that's transportation, guys, okay? Your daily commute is deductible. Everything else generally is going to be a deductible expense. You have the choice in operating your car, how you want to go about it. Now your travel expenses, guys, again, that's your meals, that's your hotel, anything once you hit the ground at the business location, okay? There is an overnight requirement. I don't remember if we talked about that, did we? We did. Okay, so if you go on a trip, you fly back and forth to St. Louis in the same day, you, believe it or not, cannot deduct your meals, okay? It's not allowed. You have to actually stay overnight before you can deduct the cost of meals. The other travel expenses, assuming it's considered primarily business, are deductible. Now, we're gonna have a slight rule change here, okay? We'll cover domestic travel again, then we're gonna talk about foreign travel second. Domestic travel, guys, okay? We have to look at the primary reason for our trip, okay? We have our transportation expenses, and then we have our travel expenses. Now, obviously, guys, if the trip is 100% for business reasons, your expenses are going to be 100% deductible, with the exception of your meals and entertainment, only 50%, okay? If your trip is primarily for business purposes, but there's a little bit of personal in there, okay? So I go on a week-long trip, I do 5 days of business, and I have 2 personal days. My trip is primarily for business purposes, okay? All of my transportation expenses of getting to and from whatever location will be fully deductible in that case. But my travel portion of the expenses, once I'm on the ground, I have to prorate between business days and non-business days. So in this case, I get 5 days of hotel, 2 days of personal hotel, not deductible, okay? I get 50% of 5 days worth of meals. And then the other 2 days of meals would be non-deductible, okay? If the trip is primarily personal in nature, so now we flip it around. I go on a week-long trip, it's 5 days of personal, and I tack 2 days of business onto my trip, okay? The rules for domestic travel say that I can't deduct any of my transportation costs. That is my personal expense. The only thing I could deduct now are the 2 days of hotel, and the 2 days at 50% for my meals and entertainment. That's it. Okay, foreign travel is going to change now, guys. Not the same rule. Again, if it's 100% business trip, it's going to be 100% deductible. No great mystery. Now my travel expenses, when I'm dealing with foreign travel, guys, my travel expenses, the ones while I'm on the ground, okay? Those are always going to be prorated between my business and my non-business days, okay? But the transportation expenses are different, okay? If my trip is primarily personal, I can get 0 deduction for my transportation expenses, getting to and from. So if I go on a 10-day trip to France, okay, and I spend 7 days doing personal and 3 days of business, well then, none of my transportation, none of my airfare, none of my cabs back and forth are going to be deductible. And only 3 days worth of my hotel, my meals, etc. will be deductible, okay? But none of my getting back and forth will be deductible. That's not different from domestic, okay? What's different from domestic here is that if my trip is primarily for business now, okay? Primarily for business, so I do 7 days of business while I'm in France and I have 3 days of personal, okay? I can only deduct 7/10 of my transportation, okay? 7/10 of my transportation, as well as 7/10 of my travel. Okay, so domestic, guys, it's an all or nothing proposition, okay? If it's primarily personal, I can business, I have to prorate it business versus personal days. Good. Guys, I'm actually going to let you out of here because we got way ahead of where I needed to be. And you guys are uneasy today anyway. I wrote something down. There's a small section at the bottom here, guys. It talks about property use. They're just pointing out, look, that you may buy certain assets, and this is particularly with closely held businesses, sole proprietors, and you may buy certain assets, guys, that you're going to use personally and that you're going to use for your business. So I might buy a laptop. I might have a small accounting business at home, okay? If I buy it with my personal funds, but I use it 40% for business purposes, guys, well, I can deduct 40% of it under my business on my Schedule C, okay? If I buy it with my business funds, okay, my sole proprietorship actually incurs the cost for this laptop, and I use it 40% for personal, well, my business can only take a 60% deduction, okay? They're never gonna give you more than what you're actually using. That's a little bit of common sense there. Some of these properties are called listed properties, and there's rules about how to depreciate these properties, okay? Again, these are properties that are very high instances of personal versus business use, and we'll talk about those as we get into depreciation. But again, just know that, you know, certain assets, guys, I don't care if your business paid for 100% of it. If you're only using it 60% for business purposes, that's all the deduction you're gonna get. They're not gonna give you a 100% deduction. Now, I'm not saying people aren't doing that, but the technically right way is to only take a 60% deduction. All right, guys.